would agree with Victoria that we do see room to run. However, tactically, in the short term, it's going to get worse before it gets better. And specifically, there are too many headlines out there through the Fed meeting, September 18th, where you could get knocks to the market. And in particular, I believe the administration does not have an incentive to make any kind of concession to China before that Fed meeting, because the administration wants rate cuts and is more likely to get rate cuts if the trade issue remains alive, well, and hot.
If that is the motivation from the tough line from President Trump on China, then if you can look past September and then the next Fed meeting, then will you see a changing of the tone on China trade from the president?
I think you will, but I think that it happens in 2020 because, if you're running for president, you don't mind some market volatility in the year before the election. But the year of the election, you'd like markets to be moving higher. Having said that, I do think whatever deal is cut is going to be a skinny deal. It's not going to be the large IP technology transfer deal that markets had hoped for. It is definitely further along in 2020. The other thing that's happening is, as you mentioned in the beginning of the hour, is that all the investment banks are cutting numbers and cutting growth. And that is appropriate. And the question is, this is happening today, mid-August, and not in early May, when the trade war actually ratcheted up and there was the expectation that it was going to be swept under the rug. The truth is those fourth quarter numbers were high, and so they're coming down to a more realistic place now.
Victoria, I mean, how bearish, though, are some of those notes? The Goldman Sachs ones grabbed a lot of headlines today. It's still 1.8% GDP growth for Q4. Is it more of a kind of catch up to where the market already was, as opposed to predicting stuff that the market hadn't thought was coming around the corner?
Well, I think you have a lot of different thoughts depending on what perspective you want to take. So for us, we do anticipate that the market's going to continue to move higher. We're looking about 3,100 on the S&P. And like Alicia said, there will be fits and starts to that. But growth numbers are coming down, both GDP numbers and the earnings estimates. I mean, continually this year, we've seen every quarter estimates for earnings per share come down. Now the fourth quarter that originally was like 900 basis point move higher, we're down to around 400 basis points on that. So I think it's across the board. You're seeing all the expectations come down.
So, Alicia, when I hear you talk about it possibly getting worse before it gets better, this idea of fits and starts, that sounds like it could be potential buying opportunities. What would you be buying?
Well, that's exactly right. So this is the year that reminded investors that diversification is the name of the game. And when you're tempted to move out of one asset class, you probably shouldn't, because you made money on both sides here. So we think you can still buy duration here for precisely the global bond problem, which is you've got $15 trillion of negative yielding debt. We still see rallies in the U.S. bond market. When the S&P hits certain technical levels, I'd be interested, believe it or not, in the cyclicals, because they're getting killed, and they're getting killed more than the other sectors. We've been very negative on biotech and pharma until now, and it feels as if that trade is ready to happen. So I'd look at cyclicals, and I'd look at pharma and biotech when the selling has come in.